So you might have heard that you can't beat the markets. But why do people say that? Is it true? Today we're going to talk about efficient market hypothesis. Hi, I'm Scott Hamilton, certified financial planner, fee only fiduciary. We have offices in Austin and Houston, and our objective is to help families retire tax efficiently. So, what is EMH? Efficient market hypothesis. Well, Eugene Fama, back in the 1960s, University of Chicago, the father of modern finance, and by the way, he got a Nobel Prize for it in 2013. He created a hypothesis, said basically all information that's publicly available is instantly available in the stock price. So stock prices are instantly updated as soon as some information gets publicly available. Now, there's a couple of forms of the efficient market hypothesis: the weak form, which it's only past data; the semi-strong form, which is all data except for insider information. The strong form says even inside information's included. Now, I think what Fama would argue for is the semi-strong model. And by the way, that's what I believe in. I am a firm believer that as soon as information hits public, it's instantly available. Because think how many analysts there are globally, how many analysts and investors and just hedge funds and money management funds. There's so many people looking at this that I am personally a big fan of the efficient market hypothesis. It's there. All the data is currently in the stock price. You can tell a lot from the prices of stocks, bonds, investments, because all data in theory is known there. Okay, what this means in plain English? Well, if efficient market hypothesis is true, picking individual stocks is basically guesswork. And I believe that. You're not smarter than the collective market. Millions of people and sellers with the same information. It's a loser's game to try to beat those. So really, whenever you watch something on CNBC saying you should buy this, and then he's telling it to a couple 100,000 people, everybody in the world, in essence, already knows that information. So that's nothing new. So if you take a tip from CNBC and go make an investment, maybe it'll work out for you. I hope it does. Good for you. But there's lots of academic studies out there that says that you're not going to consistently beat the market by trying to pick individual stocks. All right, so let's switch over to the case for efficient market hypothesis and why it holds up. So the S&P 500, you know what that is the 500 largest, stocks in the U.S., right? And they beat, actively managed funds 85 to 90% of the time over a 20-year period. It's just hard to do. I mean, and yeah. So Warren Buffett has said, the best thing for most investors is just to invest in an index fund. So that right there cuts right to the chase. Active fund managers charge 1%. And by the way, hedge funds, 2% fee, 20% of the profits. So, and the hedge funds, some of these guys, it's the best minds in the world are operating these hedge funds. And you know what? On average, they're just not beating the S&P 500 consistently over time. Sometimes there's outliers, and it does happen. So I'm not saying never. It's not perfect. It's a theory. It's a model, right? So it's a way to frame your vision of the market. If you think you're going to pick individual stocks and beat the market, good luck to you. It might be a hobby, it might be a passion of yours, but academics says it's probably not going to consist. The math is really brutal. After fees and taxes, beating the market is really, really hard. All right, so how about the counter argument? Where this EMH gets complicated? Well, Buffett exists. And a lot of people will say that he's the greatest investor of all time, right? But how about Peter Lynch with Fidelity's Magellan? He was, beating the market. He had 39% returns for years. And then the Medallion Fund from Renaissance Technology, it's a hedge fund, very limited investors, very restricted, but they were at 66% annual return for decades. Hard to repeat that, but and then so Buffett, Peter Lynch, Medallion Fund, and then behavioral finance. So you got behavioral finance clashing with this efficient market hypothesis. Behavioral finance says people aren't rational. Markets aren't always efficient. And I mean, I guess I agree with all of this. Bubbles happen. That's the third argument, the counter argument. Bubbles happen. Dot-com in 2000, housing 2008. The prices weren't effectively, accurately priced then. So those are anomalies. Those are bubbles. But then again, EMH is a model, not a perfect prediction system. It's a way to frame how markets operate. So that's a key takeaway. So the practical reality for regular investors, what should you do? Even if markets aren't perfectly efficient, exploiting the inefficiencies is highly complicated, right? So think of all the hedge funds, high frequency traders out there. These guys got the best minds working for them and millions, hundreds of millions of dollars to improve their, the high frequency traders, just to get a millisecond faster on speeds for the trades. Individual investor has no chance against that. And that's who you're competing against. If you're buying and selling, chances are there's a high frequency trader on the other side of that, or a hedge fund that's just, waiting for that order to come through. So the question really isn't, is EMH accurate? Is it perfectly true? Can you beat the market consistently after fees? And the reality says probably not. So what does this mean for your portfolio, for the clients, right? Short answer, low cost index funds, right? Hard to beat. Vanguard S&P 500 index fund, 3 basis points, 0.03% versus 100 basis points or 1% for active management. So, if you go with a low cost index fund, you're already so much better off, right? The difference compounds enormously over time. That cost difference, go out 20 years, you're saving a lot in fees. So ultimately, what should you do? Well, just assume you can't beat the market, and that's okay. Because really what our goal is not to beat the market. Our goal is to make sure that your financial objectives are being met. And that's why you need a financial plan, so you can see what my goals are, what my objectives are, how much of a return and how much risk I need to take to achieve my goals. And then don't worry about where you're at versus the S&P 500 or any other index. So a financial advisor's job is not to beat the market, is to avoid making the big behavioral finance mistakes, which is, oh my God, something happened, we have to move everything to cash. No, let's have a plan, let's stick with the plan and operate, as if the efficient market hypothesis exists, but also realize that anomalies exist. Behavioral finance is real, bubbles happen. So if we combine these all together, the short answer is, it's possible to beat the market consistently, but to do it after taxes and fees is very challenging. So work with a financial advisor to come up with a plan and have the EMA, efficient market hypothesis, as a framework for understanding how the markets work. Okay, thanks for watching. Please reach out to our website, hamiltonfinancialplanning.com. Give me a call. I'd love to chat with you about this or any other topics. Thanks for watching. So if you get a chance, click on the link below, and we'll be able to send you this pamphlet we created. It's 8 foolproof ways to reach your retirement number faster, right? It's good content, good data. Please click below, and we'll send you a copy. Thanks.